Accounts Teachings by Ramesh Kumar. Consignment account continued. Calculation of consignment stock. For calculating the value of stock, consignment stock, we will consider the cost price of the remaining goods. Suppose out of 1000 cycles, 20 cycles are left, or out of 100 cycles, that is 20 cycles are left, 80 cycles have been sold. The cost price of 20 cycle, each cycle we have consigned to him at rupees 700 per cycle. So cost price of the 20 cycles would be 14,000. To this we will add proportionate direct expenses of consignor. That is 8,000 into 100 upon 20. On 100 cycle it is 8,000, on 8,000 upon 100 into 20. It comes 1,600. Add proportionate expenses incurred by consignee, which he has incurred from the station of his destination to his godown. Suppose he is living in Bombay, and from Bombay station to his godown, whatever expenses he is incurring, whether transportation, octroi, or any other on the way, will be apportioned. Suppose he has incurred 800 expenses. On 100 cycle 800, on 800 upon 100, and on 20 cycles into 20. It comes 160. The total comes to 15,760. Now what would be the journal entry in the books of consignor for consignment stock? Consignment stock account debit to consignment. Consignee will not pass any entry for the stock. Why? Because he does not pass any entry for receiving the goods. When he does, these goods are not his goods, these goods are of the consignor. Consignment stock account debit to consignment. Now sometimes the goods are sent on invoice price. What is invoice price? It is a price which the consignor thinks may cover expenses, a commission of consignee, as well as a normal profit. When he is sending goods at invoice price, in that case, extra entries for loading on the goods consigned and on balance of stock will be passed. In the question, loading may be on cost price or invoice price. If it is on cost price, it is simple. But when percentage is on invoice price, then for calculating the loading, we will have to multiply rate upon rate plus 100. If it is 20%, 20 upon 100, 20. If it is 10%, 10 upon 100, 10. For example, cost price of each cycle is 500. they are invoiced 20% more than the cost price, then we can find the loading easily. Cost price is 500, 20% on cost. If we are invoicing 100 cycles, for 100 cycles, if it is, we are invoicing 500 cycles, if it is 100, it comes to 50,000. 20% of that would be 10,000. Then the invoice price would be 60,000. And the entry for loading would be 10,000. But if he is giving invoice value and it is given that is he is invoicing at 650 per cycle at 25% on invoice price, then the loading on each cycle would be 650 into 25 upon 125. That is equal to 130. Same way we can calculate balance of unsold stock. Journal entries would be for goods sent on consignment account debit to consignment. Because when we send the goods, we write consignment account debit to goods sent on consignment. For loading, we will reverse the entry, goods sent on consignment account debit to consignment. And for consignment stock also, we write consignment stock account debit to consignment. But for loading, we will write consignment account debit to stock suspense account. Now we are considering normal loss and abnormal loss. Normal loss. This may be due to the nature of the goods, because some goods are of such nature that they lose their weight due to change of seasons. Like we are sending vegetables or fruits or something, then on the way it loses its weight. Therefore, normal loss may be due to shortage, wastage, shrinkage, evaporation, etc. This loss is never calculated but inflates the value of consignment stock. For example, consignor consigned 500 bags of coal at rupees 200 per bag, but in fact it turned out to be 480 bags. It means 20 bags have been turned into coal ash. Now the cost price of 480 bags would be 480 into 200. And for calculating closing stock also 480 bags would be considered. Then the other one is abnormal loss. This loss is of not recurring nature. What do you mean by recurring nature? That it not repeats again and again. Every year it is not happen so. It is once in a blue moon only. It may be due to fire, theft, accident, floods, natural calamity, etc. Good loss may be fully insured. In that case, insurance company account debit to consignment with the full amount. When they are partly insured, insurance company account debit whatever we can recover from the insurance company. Profit and loss account debit, that part which we cannot recover from the insurance company, to consignment account. If the goods lost are uninsured, then the entire loss would be profit and loss account debit to consignment. Then we are coming to overriding commission. When the consignee sells more than the agreed value of the goods, then he is allowed an extra commission called overriding commission. Suppose he has agreed to sell 8,000 cycles, but he sells 10,000 cycles. How much? 2,000 he has sold extra. So he will be given overriding commission. Overriding commission means in addition to the commission already agreed, he will be given an extra commission which is called overriding commission. He will be rewarded for his extra work, so that in future also he carry on with the extra work. So this is called overriding commission. Commission may be of any type, but the entry would be consignment account debit to consignee. Because we will give credit to consignee and this is the expense of consignor. With this, we close this chapter and we will learn the entries in the books of consignee in our next lesson. If you like this video, kindly like, share and subscribe it. Tell your other friends also to see the videos and take advantage of